Optimism that lawmakers will pass tax legislation in Washington, driving these markets to new all-time highs. Joining us now is Canaccord Chief Market Strategist, Senior Managing Director Tony Dwyer. How much more can we go? Upside.
Well, if you use 21% corporate tax rate and discount everything else, just the 21% corporate tax rate raises S&P operating profits by about 9%. So we would move our 140 estimate on the S&P in terms of earnings per share to 155, which would give us a 3,100 target for the S&P. We're putting a 20 multiple on that.
So that's about a 15% gain from current levels on the S&P 500.
And that's just really conservative, Dagan. I know it sounds insane, but it's really conservative. So when you look at things like the yield curve, it's counterintuitive. We talk a lot about how the yield curve is flattening and somehow that's being perceived as negative. It's actually a great buy signal over the intermediate term. When you hit the 2-year and 10-year spread to 60 basis points for the first time in a cycle, which we recently did, and everybody was like, oh, my God, the yield curve's at 60 basis points. You go up median 63% over the course of 1,000 trading days.
Well, and the one thing that I don't think anyone's also talking about, you and I discussed this in the green room, is that when the Fed starts raising rates, it's normal for the yield curve to flatten.
It's absolutely normal. There is nothing different about this cycle. It's longer because we had to come out of a financial crisis. The Fed had to stay easier for longer, but human nature doesn't change.
But the Fed's never unwound their balance sheet in history, right, at a tune of $4.5 trillion. Isn't that different?
Each cycle brings new and different things. For example, and you're right. So, for example, if I told you at the end of 2013 that our two largest holders of treasuries, China and Japan, we're not only going to not buy treasuries, but we're actually going to sell $250 billion worth of treasuries, would you have bet that interest rates go down?
No.
No, not a chance. Right. There's a lot of unique things that are happening. What's happening because of the yield curve and all the other areas of credit, they're in such demand that it's not making a difference. When the Fed announced that they're going to reduce the size of the balance sheet, commercial banks actually picked up their buying of treasuries. Yields came down. So we have to be really careful to think that it's different this time. It's just not.
So short-term, long-term. So short-term, do you expect a sell-off after a little bit of a sell-off after the tax bill is passed because of the enthusiasm? And in a year from now, where are we going to be with the markets?
A year from now, we're going to be substantially higher. So, you know, you want to make God laugh, give him your plan. So here's my plan. You know, if we replicate we're replicating 1995. Basically, historically low volatility, historically low drawdown, consistent upside. The peak for 1995 came with a Fed rate cut, a positive event. We would consider the tax legislation very similar to that, where you could see maybe a 2 to 3% pullback. I call it kind of the Sanford and Son pullback, if you remember the show. You know, he grabs, oh, my God, I'm coming, Elizabeth is having a heart attack, but it's nothing. And I think that's what a correction near term is going to look like. You have to buy it. You never, ever, 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 ever want to sell the market and get negative on the market other than for a trade when you have a positively sloped yield curve that's flattening.
But do you buy the market now? What sectors, or do you wait for that pullback? And what's going to signal to the retail investor that now's the time to buy?
Well, Wall Street's famous for people like me acting like they actually know what you should do. And I think it's truly something that
you don't know what to do?
We appreciate
I will give you the
honesty.
scenario, and then you guys can figure it out. So with that scenario, if I'm telling you that you have the potential for 3,100 next year and you're currently at 27 something, why would you not buy any weakness? So if you can, here's the problem. Investors say that a correction is natural, normal, and healthy. It's only considered that way until you actually get one. Right. And then all of a sudden you start to worry that it's something bigger and you sell into it instead of doing the opposite, which should be buying into it.
Well, so on that point, I would just ask, you saw when the tech started selling off, it was probably definitely a gift for that sector. You saw it go swiftly, though. Does that tell you that maybe the money is in the wrong hands here?
It is, Lizzie. That's a great point. The money is, I would consider, in weak hands. If you're a hedge fund or long only even, and you're kind of cautiously optimistic, which is the classic idiot hedge, you know, if you're cautiously optimistic,
I would smack you in the arm if I could reach you from
Talk
here.
to Dagan.
Come on,
it's that cautiously optimistic. You're either optimistic or you're cautious.
No, right. So I'm optimistic, right? So, right. No, it's a terrible hedge that we use. But here's the thing. What happens when you get dragged into the market because it's going up? If you're up 20% for the year and you've been cautious all year, you're going to lose your investors if you're underperforming. So you get dragged in. You have to get in.
Well, that's
when
what...
you get the first pullback, what are you going to do? You're not a highly convicted long, to your point, Lindsay. You don't really want to be in, and you're going to sell it quickly. And I think that's the opportunity for those people that actually look at the history of what happens in environments like that.
Well, that's what John Hilsenrath was talking about, that momentum in the markets does tend to build on itself. And that's part of it. And optimism begets optimism, which I think is what you've seen in the economy this year. I think
Truly.
that we're not, given the fact that 2/3 of this economy is the consumer, that the market's up, it's hitting one record after another after another. And when you started the year, people were trying to talk down the market, trying to talk it. They're trying to talk down the economy based purely on the fact that President Trump is sitting in the White House. But it didn't work.
No, and actually you had the Citigroup Economic Surprise Index hitting like a -70, which is a historic low in the context of a non-recession environment. We actually raised our target at that point because anytime you get that negative in a positive fundamental backdrop, meaning a credit backdrop, you absolutely have to buy it. It's kind of opposite day, going to the point of what do you do short term. Now you've got the Citigroup Economic Surprise Index. I think it's over it's 62 or so. You've really had a nice ramp off that low. So consumer confidence is at a high. NFIB is small business confidence is at a high.
But if I'm a new home buyer in a high tax state, do I pull back at all in terms of I'm going to go buy this new mortgage, I'm going to go after this piece of real estate? What happens to that market and then the ancillaries?
So when I look at...
Sorry, you got put on the spot.
When I look at Ramsey, which is where I live, okay, I look at Ramsey, the real estate prices didn't collapse in Jersey. They didn't collapse during the crisis because people actually want to live there. And I think that's really, if you're speculating in real estate, understand that you're speculating in real estate. How's real estate going to do now in a high-tech state? Depends on if you want to live there with your family. Right? I mean, it really comes down to, again, great question, a personal decision. Ultimately, this is going to end badly. You cannot fix debt with exponentially more debt. We're just not at that point yet. And we keep trying to play it. Like Lindsay and I were talking offset. If you're the longest bull market in history, 2011 had a 19.8% drop. That's a 20% drop.
Right. Tony, thank you so much. Tony Dwyer.
Thank you, Dagan. Great to see you guys.